You know, when it comes to Canadian taxes, it's often what you don't report that can really come back to bite you. Today, we're diving into some of those hidden reporting rules that catch so many people off guard. Let's get right into it.
Okay, so let's start with something super common. Picture this. You sold your home, you made a good profit, and you know it's tax-free, right? Because it's your principal residence. So you're all good, no paperwork, nothing to tell the government. Or are you? Well, the real answer might just surprise you. And that brings us right to our first big misconception, the whole deal with your principal residence. That tax-free gain you made, it's not automatic. The government is happy to give you that benefit, but only if you do one really crucial thing first. So here's where there's a huge gap between what we think and what the CRA, the Canada Revenue Agency, actually requires. Most people figure no tax equals no forms. Makes sense, right? But the CRA sees it differently. To actually claim that tax-free benefit, you have to formally report the sale. Think of it less like a passive benefit you just get and more like a proactive step you have to take. Now, the good news is it's actually pretty straightforward. It's just a two-step process right there in your tax return. You fill out the details of the sale, and then you use a specific form to officially designate that property. It's kind of like raising your hand and just telling the CRA, hey, over here, this is the house I'm claiming the tax exemption on. So why is this such a big deal? Well, if you forget to report the sale, the CRA can actually come back and deny the tax-free status on your entire profit. Yeah, you might be able to fix it later, but that usually involves some pretty hefty penalties. So the takeaway here is simple, just report the sale, protect that gain. Okay, now let's switch gears a bit. We're going to go from property here in Canada to assets you might hold outside the country. This is where a form called the T1135 comes into play. And believe me, it's a big one for a lot of Canadian residents. This number right here is the magic number, 100,000 Canadian dollars. If at any point in the year, the total original cost of your foreign assets went over this amount, you have to file this form. And notice I said cost. It's not about the current market value, it's what you paid for it. So what actually counts toward that 100 grand? Well, think about things that can generate income. We're talking foreign bank accounts, rental properties you own in another country, or stocks sitting in a foreign brokerage account. What's not included is your personal stuff, like that family vacation home you don't rent out or personal jewelry. That stuff doesn't go on this form. Now, to try and make this a little easier, the CRA has a two-tiered system. If your assets are somewhere between 100,000 and 250,000, you get to use a simplified method. It's basically just checking a few boxes. If you're over that 250 mark, the form does ask for more detail, but, and this is important, you still don't have to send in all your bank statements or anything with your return. But what happens if you just forget to file this form? Well, the penalties can be steep. They start at $25 for every single day you're late. And that $25 a day adds up fast, all the way to a maximum penalty of $2,500. And keep in mind, that's just for filing late. If the CRA thinks you intentionally didn't file, the penalties can get much, much higher. So why does the CRA even want all this info? This is maybe the most important part to understand. The T1135 is all about transparency, not about taxation. The CRA is not taxing you on the assets themselves. They just want to make sure that the income from those assets is being reported correctly here in Canada. That's the whole point. Now, speaking of that T1135 rule, there's a really crucial exception, and this one is specifically for newcomers to Canada. The rule is actually really simple. In the very first year you become a Canadian tax resident, you are completely exempt from filing the T1135. You get a pass. The reporting requirement only kicks in starting with your second tax return in the country. It's basically a one-year grace period. But here is a critical distinction for newcomers. While you get a pass on reporting the assets in that first year, you absolutely do not get a pass on the income they make. Any interest, dividends, or rental income you earned from the very day you arrived in Canada, that has to be reported on your very first tax return.
Okay, for our last point, let's look at something a bit more advanced. It kind of works silently in the background of your tax return. It sounds complicated, it's called your CNI, but it can be super important for your financial future. So CNIL stands for Cumulative Net Investment Loss. The easiest way to think of it is as the CRA's lifetime scorecard for your investments. It just keeps a running total of your investment income versus your investment expenses and losses. And why should you care? Because having a low or zero CNIL balance is what makes you eligible for some really huge tax breaks later on, like the lifetime capital gains exemption. A term like cumulative net investment loss probably has you asking one question right away. Oh man, do I have to calculate this complicated number myself every single year? And thankfully, the answer is a big, resounding no. As long as you're entering your investment details correctly each year, your tax software does all the heavy lifting. It just automatically calculates your CNIL balance in the background. Your only job is to make sure you keep a copy of that calculation for your records.
So we've covered selling your home, foreign assets, and that CNIL scorecard. What's the main thing to take away from all of this?
It really all boils down to a few key ideas. First, and this is the big one, never assume that tax-free also means paperwork-free. Second, just being proactive with your reporting is your best defense against future headaches and penalties. Third, let your tax software do its job. It's designed to handle this kind of complex stuff. And finally, if you're ever in doubt about any of this, just ask a professional. It's always worth it. So we'll leave you with this final thought. Now that you know about these hidden rules, what's one simple step you can take today to get ready and make sure your next tax return is completely mistake-free? Thanks so much for joining us for this explainer.